Okay, welcome back to Accounting 401 for the spring 2023 semester. We'll be talking Chapter 3, Tax Planning Strategies and Related Limitations. Oh, hold on, I got a power cord off. Okay, welcome back. Now we got power, maybe we can get somewhere. Okay. Strategies. All of them have limitations because the IRS makes the rules. People come up with various ways to try to minimize their taxes, and if it gets too costly for the government will just change the rules or try to put some type of limitations on them. So we'll be visiting the three basic strategies, and then look at their limitations. As always, I suggest you read the learning objectives and then go to the back of the chapter and look at the key terms before you read the chapter. And keeping the key terms in mind, it'll help you prioritize some things. So basic first topic is the basic planning overview. Okay. And they give you the key facts. They really do a nice job with those key facts. There are two things people aren't aware of, generally speaking, and that is just deferring tax, putting it off as long as you can. You're going to be paying it off with cheaper dollars, especially when inflation is running like it is now. The other thing is, some people lose sight of the fact that they just look at the tax effect and they don't take a step back and look at the bigger picture, the long run, and how it impacts your wealth, your overall wealth. Sometimes it is advantageous to pay a little bit more tax on the front end going in, and then over the course of 3 to 5 years have a better, higher net worth. So it's not about minimizing your tax, it's about maximizing your wealth in reality. And that's what they have in the key facts here. Effective tax planning maximizes the taxpayer's after-tax wealth while achieving the taxpayer's non-tax goals. As we know by now that municipal interest on municipal bonds is not subject to federal taxation. However, they don't pay as much as some other bonds, corporate bonds. So you want to look at, maybe it would be advantageous to purchase the corporate bonds and pay a higher rate of interest, pay the tax, and depending on what tax bracket you're in, you'll be better off at the end of a given period of time. Okay. I like this second one under the key facts. Virtually every transaction includes three parties. The two parties involved in taxation in the transaction and the government, uninvited silent partner. At the third bullet there under the key facts, astute tax planning requires an understanding of tax and non-tax costs from the perspective of both the taxpayer and other parties. Okay, down at the bottom of that page in my ebook, they list the three types of strategies, three basic strategies. First one being the timing, and we just talked about that a few minutes ago. Deferring income or accelerating expenses, deductions, or sometimes it could be also accelerating income if rates are low and they're going to be going higher in the future or next year. Number two, income shifting. shifting income from high to low tax rate taxpayers. This is usually done with a family that has a family business by putting grandparents, mom and dad, or the kids on the payroll. And again, it has to be modified. It just can't be a paper transaction. They have to actually provide some type of service to the company, to the business. And the third basic tax strategy is called the converting, and that is converting income from high to low tax rate activities. And there's various ways to go about that. And dividends get preferential treatment. So if you're in a high bracket, you like dividends because the max is 15%. So if you're in a 37% bracket and you have a corporation that you have some influence or control over, you reduce your salary and take more out in dividends. Okay, but then the IRS can also come up with a thing called the constructive dividend. Timing strategy. Okay, because of the time value of money, they go to a little discourse on that to refresh our memories if we had it in the past. If not, the theory, basic theory, time value of money is that a dollar today is worth more than a dollar next week, next month, or next year, because the purchasing power erodes with the passage of time. Okay, so you want to pay taxes to put off paying them as long as possible, and thereby pay the government with cheaper dollars. Okay, less purchasing power. And there's various ways you can compute that with the Excel spreadsheet, a business calculator. I have a Texas Instrument BA2 here. Got a lot of buttons, a lot more buttons than just most calculators just have the 10 buttons for the numbers. This has all different functions on it. And you can also do it, there's tables you can compute those things at for clients. In fact, back when I did tax preparation work, I had a family, and the father and one daughter had some rental properties together, and I had a couple other clients where we could move different types of income to different people. The mother and dad were retired, so they were lower income. The daughter was working, so she was in not a high bracket, but higher than her parents. So they were able to do some tax planning and exercise some tax strategies with their rental properties, because rental income is a passive income unless you're doing it full time. Okay. So we want to keep that in mind, the time value of money, future value, present value. And they give you some exhibit there, show you that in 1 year time, that 4% a year from now, the dollar is only worth 96 cents. So you want to pay with the dollar that's worth a dollar. And as interest rates go higher, the value drops, as you can see in that table. And as you go out farther in time, the value drops. So again, mathematical evidence that given the higher rate of inflation and the longer you can put it off, the cheaper the dollar, you're paying it off with cheaper dollars than you would paying the tax currently. Okay. Timing strategy when tax rates are constant. Again, you got variables here. Rates can be constant, same rate next year as it is this year. You can have higher rates next year, or you can have lower rates next year. So the timing strategy, if you're able to control when income is coming in or deductible expenses are going out, the two things that play into taxable income more or less. There's different strategies of when you want to do it. Okay, so basically, you want to accelerate tax deductions, deduct an earlier period, and defer recognizing taxable income to the latter period. A few years ago, I had an electrician at the house doing some landscape lighting for me, and I've used the guy as long as I've been living here, the last 10, 12, 15 years, whatever. Boy, time flies. And this was in 2017 when the Tax Cut and Jobs Act came in to be in December 17th, 2017. And he did some work. It was November, and he usually, it's a family. It's him and his brother, and sometimes they get the bill out quick. Sometimes they don't. So it was, I guess, no, it's December, and I don't know if I called him or if he came over the house to do some other work. And I said, I never got the bill for the landscaping thing. I said, are you guys, putting off billing people until January, so it'll be income in 2018 when you're going to be in the lower tax brackets, and or did you just forget about it, or are you just that busy? And he says, well, we could save money by not billing our last, November and December work till January. I said, yeah. So he talked to his brother, and then he said, would you mind not paying me till January? I said, no, I don't mind at all. And I probably ended up saving them several hundred, if not several $1,000s, because they didn't send any bills out for December. And they were able to report that income in 2018 when they were in lower, the rates were lower than they were in 2017. So, right on the top, let's see, I can with these electronic book, it gives me a page reference here, page 35. I don't know if that's at the top of the page or the bottom of the page. But anyway, it's just above Exhibit 3-2, and they say, this is a very nice summary of the exhibit, what they talk about in the paragraph, and then they follow it up with an example. When the tax rates are constant, when there's no change, the tax deductions, you want to accelerate the deductions into as early a time period as possible, tax year. Why? Because it maximizes the present value of the tax savings. You're going to lower your income by reporting expenses that could be put off, recognizing them earlier. Taxable income, again, logically, you want to put that off into future periods, so minimize the present value of the taxes paid. Okay. So all you're doing is, if you can control these things, usually you can if you have a Schedule C or a small family partnership or corporation. Okay. Again, this is possible because, unlike financial accounting that requires the use of the accrual basis of accounting, tax accounting, unless you're a corporation with inventories, where it's mandated to use the accrual basis. All other taxpayers are on a cash basis of accounting. Okay. So it's not when it's incurred or earned, but rather when it's paid or received. Now, they talk about tax and non-tax purposes. Right under the example 3, I guess it is. Whenever a taxpayer can accelerate a deduction without also substantially accelerating cash outflow, the timing strategy may be beneficial. You have to keep track of the fact that if you're trying to accelerate deductions, have everybody that you're going to be doing business with, hey, bill me now, and I'll pay you before the end of the year. You got to be careful you don't overextend yourself and then have to go to the bank for some operating capital. Let's see. So there's the key facts for the timing strategies. What we got there? 5 bullet points. Next thing we have to the possibility is timing strategy when the tax rates change. And again, notice I said change, which could be an increase or a decrease. Rates can be going up, rates can be going down. I would think the next change, they're probably going to be increasing because last time they changed the rates, they dropped them. All right. The italics there, the higher the tax rate, the higher the tax savings for a tax deduction. The lower the tax rate, the lower the tax cost for taxable income. Okay, so all things being equal, taxpayers should prefer to recognize deductions during high tax rate years and income during low tax rate years. Again, common sense. Those are the two major components of determining taxable income: deductions and revenue income. Okay. So let's see. Now, in other, they'll say coming up that when there were increasing tax rates, you might want to accelerate income and defer deductions because that'll give you the greatest overall net worth kick or shot. And Exhibit 3.4, when tax rates are increasing, that means next year is going to be a higher rate than this year. Tax deductions require calculations to determine optimal strategy. You got to figure it out. Sometimes the software, tax software, is really good here because you can do what ifs you can put in and see what it is. So you have to calculate it out. And I'm not saying it's tricky. It may be a little tedious, but you can play around with things and see what the impact would be with the software, and before you print it out and put it in paper or file it. So the taxpayer must calculate whether the benefit of accelerating the deduction outweighs the disadvantage of recognizing the deduction in the lower tax rate year. As far as income goes, requires also a calculation to determine whether you should accelerate or defer it. The taxpayer must calculate whether the benefit of deferring income outweighs the disadvantages of recognizing income in the higher rate year. And they give you an example there. Option 1 and option 2, pay a $10,000 bill this year or next year, and you can see the difference there is $563 after tax costs of equipment. Okay, so there's the present value tax savings and the impact. Okay. So paying the $10,000 next year is clearly the winner. Reduces the basis. Tax Exhibit 3.5, timing tax strategy when tax rates are decreasing. Tax deductions, accelerate the deductions into the earlier years because you get more bang for the buck the higher the rate is, because you're going to lower the income. Maximize the present value tax savings from deductions due to acceleration of the deduction into earlier years that are at going to tax the income at a higher rate. So a $10 deduction, you get more of a tax benefit with a higher rate than you would next year if rates are going down. Taxable income, you want to put the income into the tax year that has the lower rate next year. This year, you're going to be in the 30% bracket. Next year, be 25%. Where do you want to have that tax? Tax at 30% or 25%? Or I don't know, did I say 25? Let's go 25% or 20%. So you want, let's say you make $100,000, you want to pay $25,000 in taxes or $20,000 in taxes. Put that $100,000, get it shifted. If you're a doctor or a dentist or some type of business, again, hold on to the bills to the customers. Don't have the customers pay you until next year when when the rates are going to be lower. Taxes and reward, that's kind of interesting. What the paying the bonuses. Okay. Again, the key facts summarize that pretty nicely. Now, here are the limitations on the timing strategies. Generally, tax law requires taxpayer to continue their investment in an asset in order to defer income recognition for tax purposes. Okay, so you can't cash it out. You have to hold that investment. For example, Bill could not sell his Dell stock in December, then choose not to recognize the income until January. He'd have to hold it and sell it in January to put off recognizing the income in January. Okay. But again, you got to look at the non-tax implications as well. Does he need the money to pay some bills or take advantage of an opportunity that presents itself? Second limitation is a constructive receipt doctrine. All right. Once you have control, you can't, if you bill a client and they send you the check in December, you can't hold that check until January and report it in next year as income. Once you have control of that check in December, it's considered income. You're delaying it by depositing it until January into your bank account. The IRS is going to say, that was an option that you did on your own. They're going to throw it out and they're going to say that is taxable receipt in December in the current year. Constructive receipt doctrine. Okay. Technical definition. It provides that the taxpayer must recognize income when it is actually or constructively received. Constructive receipt is deemed to have occurred if the income has been credited to the taxpayer's account or the income is unconditionally available to the taxpayer. So merely holding on to a check and not depositing it is not allowable because of the constructive receipt doctrine. Okay, the taxpayer is aware of the income's availability, and there are no restrictions on the taxpayer's control over the income. Income shifting strategies. These are usually done with related parties, business partners or family members, and they might have different tax situations. Also, taxpayers operating in multiple jurisdictions. That means multi-state operations, maybe multinational operations. You'd want to do as much business in the lower tax jurisdiction as possible. When I was a tax auditor, we had a thing called non-business income. That was business that was not, that was income, non-business income being more or less something that is not integral to your normal trade or business. Like selling a division, closing up a plant, that would be, instead of being allocated for state income tax purposes for multi-state filers, it would instead of being apportioned among the various states where you do business, it would be allocated to one state where the transaction took place. Sale of real estate would be in the jurisdiction where the real estate was located. It would be taken out of income, total income, and not split between New Jersey and New York and Delaware and Pennsylvania. It would be, 100% taxable to the state where the real estate was located. Transactions, again, most of these things are family businesses where people will put their teenage or college-age children on the payroll, but the IRS will require documentation and proof that the child did do work, and it has to be a reasonable amount. You can't pay a kid $100 an hour if they're going to sweep out the storeroom or wash the delivery truck. You have to go with the market rate for having that done. I'll give you an example here. Bill and Mercedes have a 32% marginal tax rate, while their daughter Margaret has a 10% marginal tax rate. So any dollar they can take from them and give to her, they're going to be saving 22 cents on each dollar. And again, if you look at the family unit, they could tell her, hey, we're going to do this. You're going to have to come in and do some work in the office or whatever, answer the phones, and we're going to, you're going to put it in for a college savings fund or something like that. Then again, if Bill and Mercedes shift $10,000 of taxable income to Margaret, it saves the family $2,200. The family unit. Okay. Now, can they do this legally? Yes and no. As you might expect, there are limitations on this type. Okay. So we see the assignment of income doctrine. That means that the income is taxed at the taxpayer who owns the asset or provides the service. And that income from that property is taxed to the individual who owns the property when the income was produced or generated. Okay, the assignment of income doctrine implies that in order to shift income, that's actually earn the income. Okay. They could employ Margaret, their daughter, in the business and pay her a $10,000 salary. The effects of this transaction are to increase the parents' taxable income by $10,000, increase the daughter's by $10,000, but the daughter's in a lower rate, lower tax bracket. All right. Now $10,000 is what, about $800 a month, and she's only coming in Saturday afternoon, one Saturday in the afternoon, so $800 for an afternoon's worth of work. The IRS is going to say that's not reasonable. They might allow $100 or $75 for an afternoon, but not $800. That's unreasonable. When it's related to party transaction, the IRS looks at it very closely. They get their magnifying glass out, and they're going to number one, they use the reasonable test. Number two, they're going to be looking at what the person actually did that you're shifting the income to. Was it only a book transaction, or did they actually come in and perform work? And then again, was it at market rates? What you would pay a non-related person to do the same job or task. Okay. And they say there, would the parents or Mercedes pay an unrelated party $10,000 to answer the phone one Saturday a month? Probably not. Other ways to shift income to children, and again, children are usually in a lower bracket than the parents. Yes, but there's also a catch. For the owner to avoid being taxed on the fruit, what they call the fruit and the tree analogy, the owner must transfer the tree. All right, so if we're going to pay rent on our building, we have to change ownership of the building to the child. Okay, if we have investments, we have to put the investments in the name of the child to have the child, the income belonging to the child and tax to the child. So you have to transfer the asset. You can't just give them the income that the asset produces. Transactions between owners and their businesses. There's a lot of abuse in this area. So again, the IRS tightens up the rules. They go to Congress, they testify, and then they tighten up the rules. They also issue their guidelines and interpretations. If you're, and again, the form of your business has some implications here, whether you're a proprietorship or a C Corp or a partnership or an LLC. If it's a flow-through entity, there's really not much you can do. If a corporation, and even if it's an S corporation, I had a client years ago. They had two corporations. They had one that owned the real estate, and another one that was the operating company that had a bowling alley in the building. And so if they had a real good year in the bowling alley, they would raise the rent. And because at the time, corporations, you got to the max rate at $50,000. So their idea was to keep both companies at $49,999 or below. And they could do that. And it's perfectly legal because they control the company. They could, depending on the volume that the bowling alley was doing, you could write the lease up that way because the corporations are separate legal entities. We're going to take a percentage of your gross income, X number of dollars per square foot plus a percentage of your gross. And that would keep both corporations in the away from the maximum rate. There are other ways you can do it by renting equipment. You could buy a vehicle, start another company, lease the vehicles. You can have again, it's real thin ice. Have somebody in the family act as a consultant. Again, consulting is kind of hard to pin down. It's not like you're transferring goods or services or direct hours. Rent property. What's the other one here? Be careful with corporations because you have the double taxation. And again, if you have you go overboard on the dividends, the IRS will throw them out and say, no, it's salary, not dividends. Distribution payment to the owner. Loaning money to your business and taking it out in interest. It's an expense to the business, going to lower business, but it's going to be income to you. Again, with the flow-through entity, everything comes back to the individual return. But if you have a corporation, then it's an expense to one party and income to the other. Interest expense would be just subject to taxable income, so you could lower your salary, because your salary, you not only have the income tax to pay, you have to pay the Social Security taxes on it. So if you can lower your salary, and if you're a self-employed individual that's incorporated, you're paying both sides of the Social Security tax. So right off the bat, that's a 15.3% reduction. So for every dollar of interest you pay. And again, you can't say, "Oh, I'm going to charge my business a 20% rate." You got to go with the market rates. Interest rates are 5-6%. You got to be in line with those. Otherwise, the IRS will come out. They have an ace up their sleeve called the function over form. So people get very creative in how they structure a transaction between themselves and a business they own. But the IRS will say, no, we're going to not look at the form, we're going to look at the essence of the transaction, and they will disallow certain things. Income shifting across jurisdictions. Well, did we talk about the limitations with the yeah, okay. Cross jurisdictions. Taxpayers that operate in multiple jurisdictions also apply the income shifting strategy. Specifically, income earned in different jurisdictions, whether it's the United States or abroad, or for state income tax purposes earned in different states, is often taxed at different rates. Okay. In fact, there are 4 states that don't have income taxes. So you want to be in one of those states if you're close by. With the proper understanding of the difference in tax laws across jurisdictions, taxpayers can use these strategies to maximize their after-tax wealth. They give an example here. Carlos's employer, King Acura, has 2 locations. The main one is in South Dakota, state with no corporate tax. Secondary location in North Dakota, maximum tax rate of 4.3%. So what tax planning strategy may save money for King Acura? Obviously, it's to shift income from North Dakota to South Dakota, where there's no tax. You're saving 4.3% on every dollar of income you can put into South Dakota. Now, this really is taken advantage of by companies that are obviously close to borders. If you're a couple hundred miles away, it gets a little bit more difficult. And they talk about a number of possibilities there with the Acura dealership transfer pricing, having cars transferred from one state to the other. And, where's the headquarters and where's the branch office? A lot of companies will set up separate corporations for each state to take advantage or to try to get out of the high tax jurisdiction. Okay, what are some of the limitations? Taxing authorities are aware of the benefits of structuring transactions across borders, and the IRS closely examines transfer pricing on international transactions. They actually have a section on, they called it domestic, a DISC, DISC, domestic international sales corporation and has special rules. Okay. What else do we have here? Conversion strategy. Uh, Ordinary income is uh, more or less what people think of when you hear the thing federal income tax. That's your W-2 wages or your Schedule C wages if you're a proprietor. Not it wouldn't be your wages, it'd be your income from your business. Um, if you can make some of these things change the nature of them to a capital gain, you're going to be at a uh, lower rate depending on your tax bracket. The capital gains are taxed at 0, 5, 10, or 15% max. So if you're in the 37% bracket and you can somehow structure something to be a capital gain, you can save yourself 15, 22%. Okay. Okay, I'm sorry, 20 is the max. So 17%. Again, people, it says here municipal bond interest exempt. But again, you got to look at the yields. Is it worth it to have tax-free income that's 2% or 10% interest on a bond and pay tax on it? So 2% interest, let's say you have $100,000, you get $2,000 interest, 10% bond, $100,000, you get 10,000 interest. And you're in the 30% bracket, you get 7,000. So you'd be 5,000 better off with the taxable bond versus the municipal bond. Oops, went too far here. So sensitive. I was doing another one with an ebook with a different publisher, and the thing is just the opposite. It takes it 4 seconds to turn a page. Just when you just look at it and touch it, and it flips. Come on. To analyze the conversion strategy, you often compare the after-tax rate of return of alternate investments rather than the before-tax rate return. And they show you that right above example 310, and they give you the two formulas there, equation 3.3 and equation 3.4. Okay. They give you a couple options here. Bill's contemplating 3 different investments, each with the same amount of risk: high dividend stock, taxable corporate bonds, and tax-exempt municipal bonds. So you can see the 3 different returns from those 3 investments. Bill's going to come to you as you do his taxes and going to say which one would be the best. So the dividends are taxed at 20%. His marginal ordinary rate is 37, so he's in the top bracket. Which investment should Bill choose? So you look at the computations there, and then the after-tax rate of return would be the high dividend stock at 6.8%. Why? Because even with the tax, with it being taxable, the rate is so much higher than and getting the preferred 20% rate, you're better off with the high dividend stock. The corporate bond is taxed at ordinary rate, 37%. So that 20% of that high dividend stock is the maximum rate for dividends. Municipal bond is not taxed, so it's 6% return. You get to keep it all. So not only that, but let's say that high dividend stock, if he holds it for more than a year and sells it, the proceeds will be treated as a long-term capital gain. Again, get preferential treatment at the maximum if he's in the same position. 20% max rate, you sell the corporate bond, it's going to be taxed at his marginal rate of 37%. Limitations of the conversion strategy. The IRS code has provisions to prevent tax rates from changing the nature of expense, income, or activities to more tax advantage status, including the depreciation recapture rules. We'll get to those later this semester. Property disposition chapter, the property acquisition cost recovery chapter. Um, yeah, you get a depreciation deduction on business assets. If you sell the asset, you depreciation expense each and every year as you have that hold that asset. When you dispose of that asset, all the depreciation that lowered your taxes in previous years is recaptured as ordinary income, and only the gain, if you have, you'll have a gain recognized, capital gain recognized, if you sell it in excess of its tax basis. Now that'll get preferential treatment, but you have to. I had a rental property and I had it for, I forget how many years I had it. I had it for a long time and it qualified for capital gains, but I got burned when I sold it because all the depreciation that I deducted over the years that I held it and rented it out, I got deductions for. Well, when you sell it, it all comes back at you to the extent of depreciation, to the extent of the gain. The IRS also has this thing called the business purpose doctrine. You have to have a reason for the IRS will challenge something and disallow business expense or transactions with no apparent underlying business motivation. They'll say, "Oh, you're just doing it to reduce your taxes." There's no other motivation there. Another one is the step transaction doctrine. That allows the IRS to collapse a series of related transactions into one transaction to determine the tax consequence. People will set up multiple companies and sell it from a personal asset to a proprietorship. Then the proprietorship will sell it to a corporation that they control. And every time they sell it, they can add $10,000 and jumping up the basis. The IRS will say, no, it's all that asset was, sold in three companies, but you control all three companies. So we're going to only look at what you originally paid for it, and that's going to be the basis to all three companies. You can't, because you control one, you step up the basis. So when you sell it, or step it down. So when you sell it, you get a capital gain and take advantage of the tax laws. They will disallow that. Substance over form, that's what I was saying before. I called it form over essence. Substance. They want to look at the actual economic impact of this transaction, regardless of its form. Again, people will structure things all kind of ways, very creatively. There's a whole bunch of sharp lawyers and tax accountants out there, tax lawyers, and they get people that years ago there was a big push on what do they call them? Mine just went blank. And the IRS cracked down on them. I'll think of it. I'm sorry. Tax shelters. That's what they call them. Tax shelters. I mean, even the name implies that there's something unsavory about it, a tax shelter. Well, the IRS went after it vigorously because the whole industry sprung up selling these things. In fact, I still hear one advertiser on the radio now invest in the oil and gas industry, and you get big returns, and you don't only pay pennies in taxes. It's a sham. It's a scam. You go into that, and you better have some pretty good legal and accounting advice because the IRS is going to really scrutinize those transactions. Again, the oil and gas industry was notorious for it. You could put, I don't know how you can do it, but these salespeople say it, and people think, oh, if I can finally get one over on the IRS, I'd be so happy. How can you put down $50,000 and deduct $75,000? Just logically and intuitively, that it's wrong, and nothing can be that good that you could put down a $50,000 investment and get $75,000 in deductions. No. Courts have been inconsistent with the application of the test, some requiring the transaction to meet either the business purpose or the economic substance test. Others require that it meets both tests. Again, with 13 circuit courts, you're going to get various, you could get 13 different opinions on it, and the IRS may or may not acquiesce, that is, agree with the circuit court. The tax court's a little bit better because they're more consistent because they're specialty courts for tax cases. But even then, I've seen cases where the IRS disagreed with the tax court, and it was almost hard to believe, but they did. I don't know if they took that and then appealed it to the U.S. Supreme Court. Supreme Court doesn't like to hear tax cases. I forget how that one turned out. It was many, many years ago. Again, the IRS, they make the rules. They have a real big lever that they can assess penalties of 40% for underpayment of failing to meet the requirements, and it's reduced to 20% if the taxpayer makes adequate disclosures on those two situations, the economic substance and the business purpose tests. Adequate disclosures. You're going to tell them you're doing something to try and cheat them out of some tax money? I don't think so. The business purpose, step transactions, substance over form, and economic substance doctrines allow the IRS to state the tax consequences of transactions that follow only the form of the Internal Revenue Code and not the spirit of the law. Okay. Again, the smell test, they said, if it looks bad, smells bad, it probably is bad. They're saying, going back to the example they had with Mercedes and her husband, giving $10,000 to the kid. They're answering the phone one Saturday afternoon. The IRS will say that's not salary. She didn't earn that. That's a gift. So they lose the deduction, and they have to pay it back, probably with interest and penalties. So even if they did some work for her mother, they would say it's not reasonable. So the amount, so they would disallow the deduction and say that substance, that was only a gift, because the amount they paid her was far in excess of what the real value she provided the businesses. Tax avoidance versus tax evasion. Avoidance is your right. In fact, the one Supreme Court, Judge Learned Hand, said you have a duty. It's almost patriotic to do tax avoidance. Tax avoidance is you following the letter of the law and reducing your income as much as possible using within the confines of the code. Tax evasion is when you go outside the code, or you don't report, or you underreport income, or over-report deductions. There was a famous gangster back in the Prohibition area operating in Chicago by the name of Al Capone. He did bootlegging, he did a whole bunch of different crimes, murder, and I don't know if he was into drugs and gambling. I think he was in that, but mostly bootlegging during Prohibition. He was tried, and they were trying to get him. They couldn't get him. Witnesses would disappear, be killed. Nobody testify against him. How they finally got him was for tax evasion. He went to San Quentin. I'm sorry, not San Quentin. Alcatraz. He was imprisoned in Alcatraz for tax evasion. Okay. In contrast to tax avoidance, tax evasion is a willful attempt to defraud the government. It falls out the confines of legal tax avoidance and may land the perpetrator within the confines of a federal prison. Okay. Now, again, evasion, avoidance. Sometimes years ago, I guess it wasn't that long ago, I made an investment in an LLC late in the year, And I filed my tax return, and I forgot all about it. And I didn't get any paperwork from them about my share of the income from the LLC. I got it at like late May or early June. And when I got it, my heart sank. Oh my God, I didn't put that on tax. So right away, I filed an amended return. And while I was preparing the amended return, I went through and I found that I had taken a itemized deduction twice. I think it was one charity. I gave them $60 or something, $30, and they subtracted 60. So I changed that on the amended return too, just to show the people that was getting review my return when I sent in the amended return that, hey, this guy's pretty honest. I told him I didn't get the paperwork. I made a copy of the envelope that the LLC sent me my tax paperwork, tax information from them on. I didn't receive it till after I filed my return. Forgot I owned it, and I forget how much I had to pay. Not much, and I don't know if I had to pay fine interest or penalties on it, if they waived it or not, because the amount was so low. Might have had to pay interest, but not a penalty because they figured I was a good guy. Yeah. There's all kind of scams out there. Taxes and religious beliefs and taxation. Years ago, that was a real thing. Of you can go in the back of some of these weird magazines, and they would, and for $50, we'll set you up as a preacher, and we'll give you papers, and they get certain tax advantages or not, and sometimes. So again, you go with your gut. If something sounds like it's not right, chances are it's probably not right. There are certain strategies that can be taken advantage of by a taxpayer, and they're in the code. And the IRS, they don't want you to pay more than you have to pay. If you want to, they'll take it, but they're under no obligation to say, hey, you missed this or you missed that, or you could have had this credit. That's up to you. But if you take every advantage that the code affords you, you have nothing to worry about. All right. And I don't know if I missed it in here or not. No, that might be the next chapter coming up with doing tax research. There's a bit of ethics involved here that they should have touched on in this chapter. When you're preparing taxes for somebody and they're involved in something that might be construed a little bit unsavory, or that it's illegal, you have a duty to tell them. You also have a duty to refuse to do their return. I had a client years ago, and they had a family member that got in trouble with the IRS, and the family member's son was in college, and they had a business, and it was a car dealership, and they gave the kid a demo. The kid didn't do anything. He was in medical school. How could he couldn't sell cars nights and weekends. He's in medical school. But they gave him a demo as a salesperson. Maybe they had him on salary too. I don't know. And they called me up and they said, oh, the trouble with so-and-so. And I said, yeah, I've been reading the papers about it. Well, could you do his son's return? And I'm thinking, oh, this kid's going to be a doctor. It'd be a good client to pick up. But I'm like, no, I don't want to get involved with it. I was under no obligation. And I'm like, it could only be a headache. The amount I'd have to charge him if I ever had to go defend him somewhere, or if they just questioned it because of being associated with his father, and his father was doing all kind of personal expenses running through the business. His Penn State tickets, they had land at the auto dealership, so they had landscapers to spruce up the property and cut the grass. Well, they were doing it at his house too, and he's deducting it. Well, that's a personal expense, not a business expense. So, things like that are unsavory. And we have a duty as tax preparers to act ethically and tell clients and inform clients, no, this you can't deduct that. And I remember years ago I was working down the line, and Jimmy Spencer, the former NASCAR driver, I don't know if it's his father or uncle that owns a junkyard down there between down around Berwick, down south of here. And somebody in the family was getting married, and they wanted to deduct the cost of the wedding. And I heard this going on. I wasn't involved with it at all. I just heard him talking about it in a store. And I'm like, they were buying stuff. Maybe it was a liquor store. And they said, "Oh yeah, that's for the wedding. We'll figure a way to deduct that." I'm like, "You can't deduct that. How can a wedding be good? It can't be advertising. There's no way it's related to the running a business, a junkyard business." But they had receipts, and if they had some type, they're gonna. And I don't know whatever came of it, but if the IRS ever audited him and they're looking like that, all right, what was the business purpose of this? One little side story, and I'll let you go. Um, there was an IRS agent out in the Midwest office, and he's looking to make a name for himself and move up his career ladder a bit. Well, he went to South Bend, Indiana, one fall Saturday afternoon. South Bend, Indiana is the hometown of the University of Notre Dame, that is noted, among other things, for their football team. He went to the local airport there, and he took pictures of all these private aircraft, corporate aircraft. Went over to the FAA, found out who they were registered to by the tail numbers, and wrote letters to all the corporations and asking them if they could explain the business purpose or the business meeting why your aircraft was in South Bend on this date in this year. And there are times when certain things like that could be deductible if you are entertaining a client or a potential client, or if you're rewarding employees for meeting or exceeding their sales goals or their performance bonus as an incentive. But if it's just the corporate executives going to Notre Dame to watch a football game on a weekend, that's not a business purpose, unless it's written in their employment contract that they will have that right of the use of corporate aircraft for so many hours per year for personal use. That's part of their compensation. Then it's deductible. If not, yeah, so again, you got to be careful with these things. There are times when the same thing, can be deductible or not deductible. And we'll get into that in future chapters. All right. That's it for chapter 3.